What's up, everybody? In today's video, I'm going to be covering the book Scandal of Money by George Gilder. And if you watch my other video, Life After Google, this is the same author that wrote that book. And George Gilder, he's a very famous technology futurist, but he's also conservative, and he likes writing about economics and money. And I really like the Life After Google book, so that's the reason I read this book. So if you like George Gilder, then you're gonna like this book. He's written a lot about economics in the past, and he was a consultant to Ronald Reagan during his administration about economics and just the economy in general. But if you're not into George Gilder, then who is this book for? This book is for just about anybody that's into economics, or maybe even looking to going into the field of economics. And maybe you're not either of those, but you're interested in money and just learning more about, how the economy works and why Wall Street is the way it is. And the full title of this book is The Scandal of Money: Why Wall Street Recovers, but the Economy Never Does. And this whole book can be basically wrapped up by that second part of the title, like why Wall Street is the way it is and why nothing ever recovers. And that's probably why he wrote that in there, to get people's attention. Even though this is more of just his ideas written down that he speaks about everywhere, and he's part of conservative institutes and things like that where he speaks about this stuff. And if you read Life After Google, you don't really have to read this book. This is one of the books where I didn't read. I listened to audio tape, and the audio tape is like 5 hours, or on the audiobook app that I use. And Life After Google was like 10 hours. And a lot of the same concepts are in both books. So you don't really need to read this book unless you really want to get more into the nitty-gritty. This book obviously has a lot of information, but there's some central topics in here that go throughout the whole book. And the first big thing that I have to talk about this book, the main concept underlying the whole thing that George Gilder believes, is that money is equal to time, or is a measure of time. Money is not a value in itself. And that's important because right now our economy, the way it's set up, is that money is a value of itself. And the reason it is that way, according to George Gilder, is because we're not tied to anything. We're not tied to the gold standard, which a lot of conservatives would like to see us go back to. And he goes over the history of that. And the reason the gold standard, it might not make sense to you, but the reason he states is that gold can be measured as time. And a lot of people will say, well, gold is just some metal, you can't use it. If the world goes to hell in a handbasket, you're not going to be able to sell gold. But it's not really, you're not really supposed to look at it that way. Gold is something that you mine out of the ground or the earth, and it takes time to mine it. And basically most of the world's gold has been found. There'll be large portions found, but it takes more time to find it and then mine it out of the earth. So the time it takes to find and mine gold is time. Basically, gold is just a measure of time. And that's why the money that we have, our fiat currency, should be measured against it, so that our money can actually have a value that that actually has values. Time. There's one thing you can't get back in life, right? And that's time. You can get almost anything else, but you can't get your time back. So that's the reason he says there. And if we're not going to use gold, then he says there's other things like cryptocurrencies and Bitcoin, because if you research Bitcoin or cryptocurrencies at all, you know that the more Bitcoins are found, the harder it is to mine more, and it takes more time. And it's 2019 right now, and next year there's going to be a fork in Bitcoin because there's going to be so many units of Bitcoin that are left. And then once those Bitcoins are found, the algorithm switches, and it makes more time in between each Bitcoin that's found. So he mentions that as well, and he's more pro Bitcoin in this book than he is in Life After Google. In Life After Google, he talks about why he doesn't believe Bitcoin can be our standard anymore, and I don't really agree with his position on that. I have a little bit of Bitcoin, but I think Bitcoin right now is pretty good measure of time. But the problem is with Bitcoin is that people don't think it can be used for day-to-day transactions. It can only be used for like large transactions and things like that. It can't fit every single kind of transaction, like software transactions and things like that. And another problem with money not equaling time is that you have to have the Federal Reserve in the US and central banks around the world to then manipulate the currencies to where they think it should be. And so this makes the value of money whatever these government institutions want it to be. And so the way they do that is, by printing more money and changing interest rates. And this creates all kinds of problems. It really incentivizes people to trade in this fiat money. And that's what one of George Gilder's big pet peeves is: foreign currency trading that results from this, trading one currency against another and currencies tying to another because there's no gold standard. So the way that they have their value is that they measure against each other. And he talks about George Soros and how he brought down the UK sterling, and I thought that was really interesting. But I've also been reading this other book called More Money Than God, which is about the creation of hedge funds. And that book really goes into way more detail about this foreign currency trading and how it can crash economies. And it talks about George Soros and other hedge funds that completely destroyed economies with foreign currency trading because they know the amount of reserves that each country has, and they can just buy or sell against those currencies. And in order for people to get investment into their countries, they have to raise interest rates. But when they do that, they end up losing all this investment in their country, and their currency crashes. And these hedge funds, they all trade alongside each other. And so once you have these crowded trades, they can crash an economy, or they can crash our financial markets. And Federal Reserve in the US, if they keep interest rates low, which they have to now, then they just encourage these hedge funds to leverage up. And they're able to leverage up because banks need to lend in order to get interest. But then when all these hedge funds are getting their money at low interest rates, they all pile into the same trades, and they make the impact on economies around the globe that much bigger. So George Gilder talks about getting rid of the Federal Reserve, tying to the gold standard, but based on my reading of More Money Than God, another thing that can happen is that governments can decrease lending, because sometimes these hedge funds, they'll leverage up, who knows, 5, 10, 20 times what their assets are. And that if they regulate that, then they can regulate the hedge funds' ability to multiply their impact. And the hedge funds and the financial markets in the US is a big problem because they all are networked together and they all pile into the same trades. So it just makes things worse. And that's another thing about the gold standard that's in this book, is that tying to the gold standard, it won't make these financial services companies the most profitable companies in the world. We'll go more towards creativity and people creating unique ideas and unique solutions, versus financial institutions, which all they do is they make money off of this foreign currency trading, interest arbitrage, and algorithmic trading, which is just the fast trading in and out of securities, there's no real value added to the economy. And that's what George Gilder speaks about. There's no value added to the economy. They're only transactions. And somebody's just constantly losing a lot of money, and somebody's profiting. It's usually the rich that are profiting in this case, and what we're talking about, and the poor, or the people in pensions and other things like that, where these algorithms take the money out of them, or your average investor just investing in a stock and then getting taken advantage of. So that's one thing, is we need to change the value of money and make it equal to time again by tying to the gold standard. And along those same lines is what I was just speaking about the Federal Reserve. Federal Reserve and just government regulation in general is stifling the economy, according to George Gilder. So if we get rid of the Federal Reserve, after we tie it to the gold standard, then it'll fix a lot of things, because he speaks about interest rates, and interest rates represent the growth in the economy. So in the US, very low interest rates, 2 to 3%. So our economy is only going to grow at 2-3%. So we need to get onto the gold standard and get away from the Federal Reserve, because the Federal Reserve is forced to keep interest rates artificially low. And so another way that impacts us as common Americans and not super wealthy is that if we're saving our money and putting it in a savings account, you're not going to get much interest off of that, because banks aren't going to give you money if they can't make money on the interest rates there. So the average investor putting money into saving money and putting it into your account, we can't gain wealth that way. So that's just something else to keep in mind. And also government regulation is another thing he speaks about. Government regulation discourages small business owners from creating small businesses, or would-be small business owners or entrepreneurs, because you don't want to have to deal with all these government regulations out there. You don't want to have to risk getting sued or getting fined by a government entity. And climate change, you don't know what climate laws that you might be breaking. And so all these and filing papers and just all these filings that you have to do in order to create your own business, and government regulation, you need to step back from that in order to allow the small guy, the average American, to create a business. Maybe you don't want to go to college. Maybe you want to have a sustainable job or some kind of job to save your money up and create your own business. And by having a lot of regulations, people don't want to do that. And also, just maybe we don't have everybody go to school because you come out with student loans and you're more worried about paying those student loans off. So you get a job and you don't create that business that you thought you would, or you don't pursue that idea that you thought was worth pursuing. And this is something he talked about in Life After Google with Peter Thiel and the Thiel Foundation, where Peter Thiel is giving money to young people to not go to college and instead invest 2 years in coming up with whatever idea they think is worth pursuing. They obviously vet the idea before they give them money, but that's something else that could be done to help grow our economy and help the average person do well. And the government regulation also goes into the last thing that I think is very important in this book, is that we as a public have not been able to participate in huge upswings in some of the most innovative companies. And he calls these the unicorns, like Lyft, Uber, and all these recent tech companies that have come up, and they haven't really gone public until way late in the game. And the only people that make money on those are the venture capitalists who funded them at the beginning, because the average American, we can't, you have to be an accredited investor to get into those. And so we're not able to participate in huge gain in those companies. Like in the past, you could participate in companies like Apple and Microsoft going public earlier, but now because of government regulation, and he specifically mentioned Sarbanes-Oxley, companies don't want to go public because they have to. Sarbanes-Oxley is basically just a bunch of accounting regulations. I'm an accountant, so I know a little bit about that. But I don't think I understand that that's probably a big reason, but I think it's just a whole bunch of other government regulations too, not just Sarbanes-Oxley, why these companies don't go public. And going public is just a pain in the butt anyway, because you do have all these disclosures. So I see what he's saying with Sarbanes-Oxley, and because of that, the average American, we haven't been able to increase our wealth as much as venture capitalists have, where they have these huge companies like Uber, Lyft, WeWork, where they get this huge upswing and they bring the company public and it's already heavily matured, and we're not going to gain as much as the venture capitalists will. But there's another thing in here. He talks about China and his belief in China, and obviously now the Chinese tariffs are in the news all the time, but he really believes in China and how the Chinese are supporting their own currency, and then their economic perspective is better than ours. So that was very interesting, and he really believes in China and the way that they're supporting their own currency there. So it's interesting there if you want to get a little bit more insight into why China isn't as bad as we make it, as bad as some people make it seem in the news, and to understand their currency as well. And it's also, in the way he explains it, is he goes into the specifics of the central bank in China and the leaders there, and which economists they chose to follow, versus in the United States, we chose to follow economists who believed in, you not tying to the gold standard. So that's why we're different there. And he just goes into a little bit more detail if you're interested in learning about that. And one last thing I'll talk about, an interesting note, was he talks about mutual funds. Everybody now, every financial advisor tells you go into low fee index funds, mutual funds, in order to, grow your retirement and just put all your money in there, because that's the only way you're going to make money. You have to participate because everybody's in the stock market. And he's like, that adds no value because there's nothing created. Again, this is just another financial product that's out there. There's nothing created. We're not investing in ideas that we think are cool. We're not investing in Uber and Lyft. We're only spreading it across, if you're in the S&P 500 funds, 500 companies, and just putting more money into that, and these funds are just getting fees. And there's when you're taking your money and you're putting it in these funds, you're just distributing it across like a zillion companies. You're not investing in yourself, and you're not investing in ideas or companies that you believe are great and it can earn you an exponential return, or you're not helping people that have truly great ideas. You're just could be investing them in large companies that are just treading along, or maybe even be spiraling downwards. So we're not really growing our economy by participating in the economy this way, in these huge funds and these huge index funds or ETFs and things like that. It's just a bunch of money swirling around the economy and no new innovative ideas. So in conclusion, if you want to learn more about the economy, then make sure to read this book and check out Life After Google as well. And the way that as Americans we can improve the economy is by going to the gold standard, by decreasing government regulation and decreasing currency manipulation by the Federal Reserve, and just getting rid of the Federal Reserve in general. So that's my review of Scandal of Money. If you like this video, make sure to give it a thumbs up and also subscribe to the channel to get my other book reviews. Thanks for watching.